Well, good morning. It's Sunday, March 3rd. Let's take a look at what's been happening in asset class and in the broader markets this week. Well, as we wrap up February, it's been an incredible month, probably one of the busiest we've seen in the last 18 or so. Actually pretty reflective of what's happening in New York today. It seems like everybody is getting back at it. A lot of activity around the city, and the markets are pretty similar. We've got the NASDAQ closing at a record high this week. We got the S&P closing at a record high at 5,100, and stocks, lots of stocks hitting their all-time high, which is interesting. Clearly, the AI boom lifting tech stocks this week, continuing to lift tech stocks. Nvidia just absolutely tearing ahead. So it's a good, every boat rises on an incoming tide. So that's good for the markets. I guess what I'm interested in is what the impact is on the broader alternatives market. When we look at the public markets, how does that impact? So let's take a look at that. So the thing to bear in mind when the public markets are performing as well as they are, it has a knock-on effect to the alternatives market. And here's the primary drivers. So if you think about the portfolios for endowments, those large institutional investors, the portfolio is going to be made up of a number of different parts. There'll certainly be equities, there'll be bonds, yes, there'll be alternatives and other asset classes. And so one of the challenges that the alternatives industry faced last year was that there was a significant mismatch between the percentage of equities, bonds, etc., and their value, and the alternatives investments that many of these institutional investors had made. It's called the denominator effect. In other words, the percentage of alternatives was much larger than they had originally anticipated because the public equities and bonds, etc., had decreased in value. Now we see, the boom times, at least in the short term, on the equities market, all-time highs, as I mentioned. That has clearly swung the pendulum back, and alternatives is a much smaller percentage of that overall market. Now, overall portfolio, should I say. So if you look at the impact of that, you have this interesting situation occurring at the moment where there's dislocation in the market. You have real estate significantly disrupted. You still have revaluations happening in the tech market despite the boom of the tech stocks. Valuations on a lot of the companies that had taken money on in 2021, early part of 22, with higher valuations, those are being marked to market. In other words, they're being marked down. And so in much the same way as you had a perfect storm a couple of years ago, for that rise, you had a perfect storm then coming into 2020 with COVID happening, the revaluations in 22. You have inflation, the threat of recession driving down those valuations. This perfect storm is now being replaced by what I think is a very interesting market dynamic. In other words, you have the public markets rebounding significantly, that denominator effect going away. You have valuations certainly much, much lower than they were in the early part of 21, 22. And as a result of that, you have significant opportunities. So we are seeing, thankfully, a very significant return to alternatives. As I mentioned, February was a really great month for us. It's looking like Q1 and indeed Q2 is stacking up very, very strongly. So I think it's a little bit too early to call it. There are definitely some challenges ahead, but the market is very healthy, and we will see here in the next 6 to 12 months how that plays out. Let's take a look at, let's say, the bullish and bearish outlook here in the midterm also. So on the bullish side, we have everything I've just mentioned, right? That uptick in the market, the fact that there are significant opportunities to be had in the market, hopefully institutional money coming back, which is a very significant amount of the pool. So that's a very bullish kind of backdrop for the return of the alternative sector. Now, I think on the bearish side, if you look at debt in the US in particular, that's hit an all-time high, a very significant percentage of that on credit card. So that's challenging. Yeah, I think one of the mitigating circumstances for that is that if you look at even at an individual household level, for those that have reasonable incomes, they will have equities. They'll have exposure to the stock market, maybe even some money in Bitcoin, which has been going through its own rally this past week or so. So I expect that households are probably feeling like, well, they have a relative wealth, and despite the fact that they may have significant debt, the markets are compensating for that. And so the public market response and the increase in their equities, perhaps Bitcoin holdings, as I say, is helping them feel like they're a little bit more prosperous than perhaps in fact they are. The stimulus, the impact of the stimulus, the government stimulus, is probably starting to wear off. Those savings are gone. People are turning to their credit cards, and it will be, I think, important and probably prudent to look at how that develops over time. But that is perhaps a little bit more of a bearish outlook. I think the other thing to note is that because of the hype in AI, and I've spent a significant amount of time over the last couple of months looking at AI, how we can apply AI in our business and for the benefit of our clients, I think there's still a tremendous amount of emperor's new clothes in that. Very, very few, lots of, I'll call them kind of outline use cases where there's some benefit. Yes, it's some time savings, some productivity gains to be had, but nothing that is game changing to me from what I've seen. And yes, we'll deploy some of those productivity saving tools in our own product, but I still do not think it compensates in any way for the billions and billions of dollars that are going into hundreds, if not thousands, of these companies. I think there's going to be a massive clear out there, and I think it will happen almost as quickly as the money went into those markets. I think that clear down is going to happen fairly quickly, as many of these companies find out that they don't have a market, or the shifting sands of the models that are existing there in AI, with the major players wiping out the business case behind these companies. So that's kind of a more bearish outlook. I'll be delighted to be proved wrong, because from my perspective, my business and the alternatives business benefits from this rise for sure. And so hopefully it continues, but a more bearish outlook might suggest that prudency certainly in the midterm might be more appropriate. So that's it for another week. Hope you have a great week ahead, and whatever you're doing, wherever you are, that you're keeping safe and well, and that we continue to prosper in this upward market. Have a great week, everybody, and we'll chat to you soon. Take care.